It's pretty easy to take clean water for granted. You turn on a tap and it's just there. But for millions of people in rural communities, it's a constant struggle. Not because we aren't building wells, but because they keep breaking down. So today, we're diving into a new idea for how to finance water systems forever. And this number right here, this is the heart of the problem. A full 25%. That means 1 out of every 4 rural water systems in sub-Saharan Africa is broken at any given moment. This isn't just an inconvenience, it's a systemic failure that costs communities their health, their time, and their future. So why does this keep happening?
Well, this quote just nails the fundamental inequity of it all. We are asking the world's most vulnerable communities to do something that people in high-income countries would never, ever be expected to do. It's a model that's basically broken from the start.
Okay, so let's dig into that. Let's break down this traditional model and see exactly why it's so unrealistic. For decades, the standard approach has been pretty hands-off once the construction is done.
It's called community-based management, or CBM. And on paper, the idea sounds pretty good, right? Build a well, train a local committee, and then expect them to collect fees from their neighbors and manage all the repairs. But the reality on the ground? Well, it's a whole lot messier.
When you look closer, you see the system is almost designed to fail. The user fees in communities where income is unpredictable, they just can't cover the true cost of a major repair. Volunteers get burned out or they move away. Finding spare parts can be a nightmare, and there's no professional technical support to call. It just creates this vicious cycle of underinvestment and breakdown.
And this chart, wow, it just lays the double standard bare, doesn't it? In wealthy countries, water is a public good. It's managed by paid professionals and subsidized by our taxes. But in these last-mile communities, we expect them to run it like a tiny, self-sufficient business. The expectation just doesn't line up with the reality at all.
So people have realized CBM has some serious flaws, and a newer, more promising approach has popped up, results-based financing. But as we're about to see, even a really good idea can have a critical blind spot. So, this is results-based financing, or RBF. The big idea here is that instead of just paying for construction, you pay professional maintenance companies for performance, for actually keeping the water flowing. It's a game changer because it shifts the focus to preventative maintenance, and it's already ensuring reliable service for over 1 million people.
RBF is a huge improvement, for sure, but it forces us to ask a really important question. In a purely market-based approach like this, who gets left behind? And the answer is what are often called last-mile communities. The smallest, most remote villages just aren't considered bankable. They don't have enough paying users to make a service contract profitable for a private company. So the very people who need the most help are the ones who are systematically excluded. To fix this, to address this gap, we've got to get smarter with our financing. This framework here helps us think about the different levels of support communities actually need. Some are hanging in and they need a full subsidy. Others are stepping up, meaning they can co-finance with a little support. And some are stepping out, totally ready for those market models. We need solutions that work for all three.
So this brings us to the really big idea, a potential solution that creates a permanent financial engine, one that's designed specifically for those communities that are hanging in and stepping up.
The idea is an endowment fund. Now, it's a simple concept, but it is so powerful. You invest a large sum of capital, and you only ever spend the investment income it generates. The original capital, the principal, is never touched. What this does is create a predictable stream of funding forever.
And look, this is not some crazy, untested idea. This is a tried and true model. Big universities, hospitals, museums, they all rely on endowments for long-term financial stability. It insulates them from the ups and downs of annual budgets or fundraising. So the real question is, why aren't we applying that same logic to an essential service like water?
This chart really captures the paradigm shift. We move from a world of unpredictable, short-term grants that pay for a single repair to a predictable, permanent income stream that pays for reliability itself. It's about financing sustainability, not just fixing the latest breakdown.
So, the idea is solid, but how do you actually make it work on the ground? Let's look at the key components you need to make this model succeed.
It really boils down to 4 key things. First, regulation. You earmark a small part of every new water project's budget to seed and grow the endowment. Second, governance. These funds are managed locally, at the district level, with oversight from the community. Third,
contracts. You use the endowment's income to fund those professional, results-based contracts. And finally, targeted subsidies. The system provides smart, differentiated support for the communities that need it most.
Now, I know this might still sound a little theoretical, but we can look at a real-world proxy case from Malawi that shows these principles in action. It's focused on flood damage instead of routine maintenance, but the core idea is the same.
So here's what happened. After a devastating cyclone, an organization called Baseflow knew that just rebuilding the hand pumps wasn't enough. So they took philanthropic capital and they invested it. The returns, an impressive 26% annually, are used to pay for flood insurance premiums. The capital is never spent, but the insurance is paid for forever. It's just a brilliant, sustainable solution.
Of course, no model is perfect, and any long-term financial strategy like this has to be realistic and honest about the potential challenges and risks involved.
In that Malawi pilot, they are actively monitoring these risks. You've got the big financial ones, like hyperinflation and market volatility. Then there's governments, making sure the fund is managed transparently and fairly. And operationally, you have to ensure contributions keep coming in to grow the fund. These are serious challenges, but acknowledging them and managing them is absolutely key to the model's success.
So this all brings us to the final, crucial takeaway. This isn't just about a clever financing mechanism. It's about fundamentally redesigning our entire approach to development.
Ultimately, the real challenge is to shift our thinking. How do we make long-term sustainability the default setting for every single project right from day one, instead of just an afterthought or a hopeful assumption?
And this quote, it just says it all. For too long, we've simply assumed that goodwill and community effort would be enough, but they're not. True, lasting sustainability has to be intentionally designed, it has to be funded, and it has to be built into the very fabric of how we provide essential services like water. We have to design forever.